Okay, cool. So we're going to just kind of go over some terminology and talk about different parts of the bookkeeping system. Um, when I started to put this together, I started to think about chess a lot and I wanted to make some analogies. So when we're talking about our bookkeeping system, the first thing that we're really dealing with is what's called our general ledger. Okay. And if I had to make an analogy and bring it to like a chess board, the game of chess, the general ledger is kind of like our board. This is where everything goes down. This is where it all happens. Okay. And so you'll hear people say the ledger or the GL. Those are terms that kind of are interchangeable within the accounting system. But this is where all of our transactions live. This is where all of our categories, which are within the chart of accounts, live. This is where everything lives. And it's really just if someone asks you, can you run a general ledger? It could just be a very long report that shows all the transactions. You hear me use the word ledger or the GL, and that's just what I'm talking about is the entire system. Okay, so the next thing that we kind of have to talk about is time. So I just started getting into playing timed chess, but I love it because it really does represent that time is a factor. And in bookkeeping, it is the same thing, right? So the way that we look at time in bookkeeping is we're looking at it either in a cash timing setting or what we call accrual timing setting. So I'm going to use examples to really make it simple. So let's just say, Omni, that I decide to buy something from you. Maybe you're selling apples, right? And I tell you, Omni, tomorrow I'm going to come back and I'm going to buy 30 apples from you. You could say, okay, cool. Until I get that $30 from you, it's $1 per apple. I'm not going to say that I made any money. Or you could say, man, I got $30, even though it actually hasn't, the money is not in your hand. You could say that that is money that you've received, right? My mom always told me, don't count any money that's not in your pocket. She always would say that because I used to get excited. My dad would be like, I'm going to give you $30 tomorrow. And I'd be so excited. Then he may or may not do it. Right. And I'll be disappointed if he didn't do it. If he did it, I feel like, okay, that was good. I'm glad I already spent it in my mind. Right. But businesses can look at it from either way. So there's some cases where it's actually, the examples that I gave were kind of like from the personal standpoint where it might be a bad thing to count that money before we've received it, right? But from a business standpoint, they may want to count that money before they receive it, right? And then it doesn't only apply to income, it applies to expenses. So I like to use the example of magazines. They're like one of my favorite examples to use. So let's just say you love Essence magazine. You say, you know what, Essence, I'm going to go ahead and subscribe for a year. I'm going to pay $120 for the year subscription. The magazine is $10 each month, but I gave them $120. So in accrual accounting, right? The $120, they have that money in their bank account. Essence received that money from me, but they actually did not earn it. So they can only account for the $10 each month. So in January, they would put $10 of income on their profit and loss. February, they add another 10, even though they have the 120. So what happens with the other portion? So let's just say in January, they put the 10 on their profit and loss. And then the remaining $111 is going to sit in what's called a liability account, because I could call Essence and say, you know what, that last magazine didn't make me happy. Run me my money back. And they will have to give me that $111 back. So it's not in their best interest to put the full 120 on the books because they haven't earned it. So that's an example of what we call deferred revenue. And this stuff gets really tricky. Accrual accounting, we're not going to deal with accrual accounting at all for this class. We're going to simply stick with cash. So anything that we talk about is money that we received. I want those apples, Omni. You're not going to give me any apples until I give you the money. I'm not going to take any apples until I have the money. Okay. But I want you guys to be aware that there is this different type of bookkeeping and accounting that goes off of what I said I'm going to do, what I did, what I received, what I didn't receive. This whole timing issue is what we call it. Okay. So that was a lot. Do you guys have any questions about cash versus accrual? No? Okay, cool. Alrighty, so we're going to jump now into the chart of accounts, okay? And I like to, again, I'm liking the analogy of chess. So this is kind of like our squares. And I love that the grid, every square has a name, right? So there's A1, B1, all of these different names on the board, right? And our chart of accounts is similar to that. There's 5 main types of accounts that we're dealing with in bookkeeping: assets, liabilities, equity, revenue, and expenses. Okay. So I just want to kind of take a quick moment to see, can anybody tell me what an asset is?
Asset is anything that you own.
Good. What's a liability?
Things that you could be held accountable for.
Okay, so money that you owe. That's a great way to describe it. Yep. Equity. Does anybody know what equity is?
Interest in something, right?
Yes, I love it. I see you getting them pre-points, them pre-Jeopardy points. What is revenue?
Money that you own.
Money earned.
Yep.
Yeah,
exactly. Okay, I'm gonna have to give it to both of y'all. Hold on, let me pull out my notes.
Oh,
You got to get in where you fit in. You got in on the assets. What are expenses?
Whole time I'm trying to give them the opportunity to say something.
Right.
Things you have to pay for are expenses.
Oh, you already
Exactly.
I said that.
What's
Yes.
the difference between liabilities and expenses?
That is a great question. So, a liability is something that you owe, right? They're both considered money out. But let's just say, I like to use the car loan as an example, right? I go to the BMW lot and I say, give me that F series, whatever, right? They give me the car and then they draft up all this paperwork and I start making payments. So I don't actually own that car, but I'm paying for it in chunks. And so that's kind of the difference between, well, that's not a good way to describe it. An expense is really going to be something that you're paying for because you've used it. No, that's not a good way to describe it either. Because I'm using the car, right? I actually have a slide that's dedicated to that, but that's a great question because they're both money out. In the example of the car, I don't own it, right? And so I have to recognize that, yes, I'm paying for it, but I'm paying for it because I don't own it. So every payment that I make is reducing the liability versus like an expense where I'm paying for, what's a good expense? I'm paying for paper. I'm going to consume that paper. And once it's done, it's done. Versus the car, once I finish paying for it, it actually becomes an asset. Does that make sense?
Okay. Yes,
Okay.
thank you.
No worries. That's a great question, though, because it's both money out. And it also gets tricky, right? Because part of that car loan is I have to pay to even be able to take on the debt. So part of my payment every month, let's say my BMW payment is $500 a month, I might be paying $500 and only $300 goes to the actual loan. And the other $200 is going to go to an expense called interest because I'm paying them for the right to even be able to rent or to buy this car. Okay, so sometimes liabilities will have a mix of, or a payment toward a liability will need to be split out to recognize that not the full portion is going to the loan, a portion of it is going to the cost of doing the loan, the interest expense, okay? Those are really good answers though. Let me just make a quick note. I should have had a little piece of paper because I wanna make sure I'm keeping track of who answered those questions. So Tamika, you had 2, Omni had 1, Phil had 1. Okay, and Norma had 1.
So is it expenses like something that you're paying for ongoing? I mean, you're using it, you're paying for it. Some expenses you never own.
Right. Some expenses you never own, but you may I like the idea of consuming is a better way to think about them,
Okay.
right? Because like I said, that pack of paper, I went to Office Depot and I bought a pack of paper because I'm going to consume it. The pens, those kind of things where they're never really going to upgrade to assets. I just need those expenses help me to run the business. But there's caveats to that, right? Because payroll is an expense, and I don't like to look at my people like something that I consume, right? But it is an expense that I have. So the best way to kind of look at this is these three here: assets, liabilities, and equity live on what's called our balance sheet. So they help us understand what our balances are. And then our revenue and our expenses live on our profit and loss, which show us money in and then money out, but from the perspective of money earned and money spent to earn that money, right? Or to operate the business, and then what's left over. So the next part we want to talk about is customers and vendors. So vendors are simply people who you purchase from, right? When Omni was selling me the apples, she's the vendor, I'm the customer, okay? If you go to Office Depot and you buy paper, you are the customer, they are the vendor. So there's times where you're the customer, there's times when you're the vendor, and it's important to recognize that. And I'll show you that in QuickBooks, okay? We have other types of transactors, but QuickBooks doesn't really recognize those. It keeps it really simple, but employees they're not customers nor vendors. They're kind of like this hybrid ground. Investors are not customers, nor are they vendor, and lenders are the same. So I just wanted to note that these are ones that you're not going to see in QuickBooks, but for the most part, QuickBooks looks at it in a very binary way, meaning money in, money out. If it's money in, it's probably from a customer. So we would treat investors as customers. And then if it's money out, hey, I heard that. Is it getting boring?
No,
Okay.
I'm just, it's cold. It's cold.
No, I get it. I'm over here bundled
I'm
up as
sorry.
well.
I'm cold. It's freezing.
It's okay. Okay, so we're going to go through these pretty quickly because you guys kind of already answered these, but I just went in and kind of defined them a little bit better. So assets are things, resources that you can own and you can convert into cash. Okay, so accounts receivable, that's an interesting one. A lot of people haven't heard that term. Do you guys know what accounts receivable is?
Accounts receivable. They're the ones that receive the accounts, aren't
And
they?
that shouldn't count because my speaker was on mute and I was
Mine
trying to
was
say
too.
something.
Mine was too, though.
Well, her answer is not right though. So,
Okay, so-
let's hear Phil. Oh, who was next?
Oh, go ahead, Philip. I'll go last.
I was gonna say money that you received, that you've received.
Yes, that's a good way to put it, but it can get even better. That's a good answer, but I want a better one.
You said
Mama, go
accounts
ahead.
receivable, right? You said accounts receivable?
Yep.
All
All right, so accounts receivable is designated accounts that money goes into.
Not quite. So accounts receivable.
Can I say it?
Yeah, okay. I
What I
didn't see
think it
it.
is.
Yes.
Is it from goods or services rendered already?
That's the piece that we're missing right there. So
Is-
again, let's
is
go
mon-
back to,
I would say, and isn't it like money that you pay out to like a debitor, like a debt or something?
as account payable.
that's accounts payable, exactly. So accounts receivable is money that they owe us. So sometimes when we're transacting in business, let's go back to the example of Omni and I, all right? I said, I'm coming back tomorrow to buy those 30 apples, okay? So Omni's gonna go into her bookkeeping system. She's gonna create an invoice for 30 apples for me, and she's gonna recognize the revenue because she's doing accrual accounting. And again, this is accounts receivable is more for accrual accounting. So she's going to recognize the revenue of $30, and then I'm either going to pay my invoice or I'm not. If I pay my invoice, then she recognizes the money once the money hits her bank account and the accounts receivable goes away. And now all we have is revenue and money in the bank. Okay, so the income went to the profit and loss, and then the money in the bank went to the balance sheet, right? If I don't pay my invoice, Omni's going to call me at 30 days and say, hey, Ari, your Apple invoice, you took the apples 30 days ago, your invoice is still outstanding. I just wanted to send you a reminder. 60 days, she's going to call me and say, hey, Ari, that invoice is getting a little old. Is there any way you can go ahead and take care of it? 90 days, she's going to say, hey, where's my money? Right? And at that point, if I still don't pay, Omni can write off that accounts, she can write off the apples because she never got paid for them. Even though she recorded the income, she now needs to say, actually, I didn't actually get that money. I already never paid her invoice. So accounts receivable we treat it as an asset because it's owed to us, just in the same way as when I take that BMW and I sign that loan note saying that I'm going to pay my loan every month, I may stop paying my loan. Okay. And now they have to come and get the car. But that's basically what that represents is it's money that is rightfully owed to us. And we put it on the balance sheet as an asset because we're counting on our customer to be righteous and pay us. But sometimes they're not. Sometimes they don't pay us. So those are things that could affect that accounts receivable account. So you guys, I think all together you got it. But no one had it like completely right. And it's one of those ones that's kind of hard to conceptualize because it's almost like you owe me, basically. That's what it is. If I have accounts receivable or AR, I'm recognizing that you owe me money. Okay. Vehicles, property, equipment, all of that, even the money in the bank is an asset. Okay. We're going to jump down into liabilities. That's debt that you owe someone else. So sometimes taxes can be considered a liability. If you're aware that you owe this money, taxes can be a liability, loans, accounts payable, meaning bills that you have to pay. Every month you get a bill for the internet. That's going to be considered accounts payable because you owe them money, right? So those are just subcategories that we may see under the liability section. Equity, we talked about this a little bit, but I like this definition because depending on how your business is set up, your equity might look different, right? If I'm an independent business owner, I don't work with anybody else, it's just me and I'm braiding hair for a living, my equity is only going to be within myself, right? If I'm a multi-member LLC and it's me and my three best friends and we all put money in, the equity is going to look different based on how much money we all decided to put in. If we're a corporation and we're accepting money from investors, we may have equity that's all over the place. So your equity really does depend on your structure, but it really just represents how much an individual owns within your company. Okay. Okay. And then revenue, we talked about this. It's the money that you bring in by selling products or services. Sometimes you have a combination of the two, right? And then we talked about expenses. This is the cost of running your business. So it could be rent, utilities, office supplies, those kind of things that we pay to just make sure that our lights stay on, that we can serve our customers. Okay. I wanted to note that in nonprofits, we don't use the word expenses, we call them expenditures. And there's just a little bit of terminology changes that you'll notice within nonprofits, but those terms become interchangeable, but for reporting purposes, you'll see on the reports expenditures versus expenses.
But it means the same thing, or what's
Yep,
the
it means the
difference?
same thing. It's just the terminology in the nonprofit world
Nonprofit world.
varies a little
Okay.
bit. Yeah, and
Thank
sometimes
you.
it just from the technical standpoint, right? You just get a few extra cool points if you say expenditures versus expenses. You know, you can at that point put a monocle on, and you're just that much cooler. Okay.